Hey, and good morning. It's Happy Friday. Good to see you today. I am Jack Gately from Jack Gately Real Estate and the Online Real Estate Academy. The more I do this show, and yes, I missed yesterday's show. Family comes first. But back at it today. The more I do this show, the more I realize some insights about how markets move with the news cycle. And from what I understand is that everything gets boiled down to its most simple, understandable thing, lowest common denominator, which I usually refer to as conventional wisdom. And everyone seems to get on this freight train of conventional wisdom. And you know what they say about conventional wisdom? There's no wisdom in it at all. And the last thing that happened with conventional wisdom were the unemployment report and the inflation report from last week. And those reports has everybody saying that interest rates have peaked and it's all gravy from here. All the buyers are going to come back into the market. All the sellers are going to come back into the market. Volume is going to go up, and it's happy days again. That is the spin out there. By the way, as we look at the market futures this morning, let me snap this here so you can see it a little bit better. That's better. We are seeing green across the board, except for the 10-year. Oh my God, what happened to oil? I guess you skip a day and oil went down to $74. Wow, I missed that. Actually, must have went actually lower than that because it's actually +1 now. So it must have went down to like 73 or 72. Wow. Well, I guess that happens in a recession. Oil dips, but green across the board, except for the 10-year, of course, which is red, which is actually good for mortgage rates. And so I must be wrong, and I'll be happy to be wrong, but I don't think I am. You tell me. I'm going to try to do better today to read the comments. I know I missed a couple of comments over the last week. I'm going to do better. My promise to you. So yeah, if you look at the mortgage chart, let's bring it up here on the screen. We hit a peak of 8.03% on the Mortgage News Daily survey on October 19th. Which is, by the way, the day that this channel got monetized. And I am going to make a video, I think probably over the weekend, about how much money the channel made in 1 month of being monetized. I think I'll make that over the weekend. And then, wow, look at that. It just dove down, crashed really to 7.38 in early November and kind of hovering around that for the last couple of days. So obviously, the race towards 8% is over, and obviously next stop 6% rates, right? Let's take a look at this chart, which is actually the same chart. It's just bigger scale. And when you look at it, oh boy, the dip that we've had over the last week or two doesn't look that significant anymore, does it? No, it doesn't. It doesn't at all. It looks like it's going in the right direction, but it's not really that big of a dip. It's that tiny little dip over to the far right of the chart. And yeah, it's the same chart. It just depends upon whether you're looking at it from the big picture or the small picture. And from the big picture, interest rates don't move that dramatically over 1 or 2 days. But the conventional wisdom is that we're going to see rates in the 6% range in the early spring of 2024. We also heard that from UBS last week. Was that last week? Here's the National Association of Realtors economists saying that. You can go over to Inman. They're cheerleading it. Mortgage rates post biggest one-day drop since onset of pandemic. The bull there. You go over to Finance YouTube. Mortgage rates to crumble. Mortgage rates have peaked. This may be the peak. I mean, just everybody is on board with the peak. I'm really kind of curious of what your feeling is. I'd love to have your comments on that. Maybe I'm completely wrong. What in the world what do I really know? But I was happy to hear that at least one of the best and brightest people that are obviously smarter than us, is somewhat still skeptical. And that is Loretta Mester. She's out of Cleveland Fed. She's out of the Cleveland Fed. And she said, we're going to have to see much more evidence that inflation is on the timely path back to 2%. Let's remind you, folks, that the target is 2%. The 2% target by the Fed, that's their stated policy. Right now, we're double that. We're double that at 4%. And remember, the inflation beat that we got on the CPI last week, it was supposed to be 4.1, and it came in at 4. I mean, it wasn't a fantastic beat. It wasn't like it was expected at 4.1 and it came in at 3.3. Right? It was a beat by 0.1%. It was not like a staggering beat. And so Loretta here is saying, whoa, easy there. Easy there. We're going to have to see much more evidence. But we do really see some good evidence that has made progress. And now the question is it continuing? And that's a good question, Loretta, because what is going to happen in the future? Nobody knows. But unfortunately, I'm going to say something nice about Loretta and everybody at the Fed, and then I'm going to say something not so nice. Unfortunately, they are absolutely positively convinced of their internal wisdom to figure this out. Listen to what she says about her own abilities. Comparing the Fed's position to navigating a ship, Mester said, we're at the crow's nest. What does the crow's nest let you do? It lets you look out on the horizon. It lets you look out of the horizon at all the data coming in, all of which is far lagging behind, and where the economy is evolving. And then we'll have to see, is it moving in the way we forecasted? If you had 100% confidence about your forecast, you wouldn't need even to get up to the crow's nest, would you? Like, if you know anything about going on a boat or sailing, you only go up to the crow's nest to check things out because you're not sure what's going on, right? Or maybe, I know we have a lot of people that don't live anywhere near the ocean. Trust me, the ocean is down the street from me here, literally at the bottom of the street where the Pilgrims landed, at the bottom of my street here. So you only go up to the crow's nest because it's kind of risky to get up there if you're not sure what's going on. But no, that's okay, Loretta. The point is that she and the rest of the Fed are entirely convinced that they can figure this out, that they're smarter than the market. Let me tell you, nobody is smarter than the market. So I've said this before and I'll say this again. So many people think that they could be Jerome Powell, that they're smarter than Jerome Powell. They could do a better job than Jerome Powell. Loretta Mester, who is she's nearing the end of her term. I think next year sometime she's out. But, every senator, Elizabeth Warren, thinks they're smarter than Jerome Powell. And I look at Jerome Powell's job and I say, I couldn't do any better. I'm going to say I couldn't do any better. In fact, I ask, why is the job being done at all? You've heard me say that before, because I don't think that they're smarter than everybody else. They're just following the conventional wisdom, which the old famous quote is, conventional wisdom is no wisdom at all. No wisdom at all. Now, the next quote comes from not my favorite economist, but he was good with a word or two. By the way, I would love your comments today. He was good with a word or two, could turn a phrase. We all agree that pessimism is the mark of a superior intellect, which is, of course, why you're watching this show. So when we look at events, to bring another John Kenneth Galbraith quote, the enemy of conventional wisdom is not ideas, but the march of events. The march of events. Jack, what events might those be? Overall supply of U.S. debt leaves few takers for U.S. Treasury. Financial Times earlier this month. Wall Street Journal this morning. Where have all the foreign buyers gone for U.S. Treasury debt? Overseas private investors and central banks now account for 30% of all outstanding debt. down from 43% a year ago. And they have a super fancy chart here. Foreigners no longer have an insatiable appetite for U.S. government debt. That's bad news for Washington. No, it's actually bad news for you, the American taxpayer. It's bad news. Very bad news, actually. I want to play you a quote here from David Kelly. He's the chief global strategist at JP Morgan. He's going to explain what's going on with interest rates and what's going to happen with them. Go ahead, David, Mr. Kelly.
And as a nation, we overspend. The reason we have a trade deficit is actually because we have a budget deficit. If you think about it this way, you got the private sector, you got the public sector, you got trade. If the private sector more or less pays its way, if we fund our investment through our savings, but if the government runs a big budget deficit, if it spends a whole pile more than it's taking in taxes, then we as a nation will live beyond our means.
If we spend more than we take in, we live beyond our means. I know that's radical.
I think this is so important. It's not a matter of tariffs. It's not a matter of the dollar. If we run a big trade budget deficit, if we continue to buy more stuff the government does and it takes it in taxes, we will run a trade deficit. So if we want to fix our trade problem, we've got to start by fixing the budget deficit.
And
okay, let's take that one more step further.
to take your analogy further, when is it okay to run a budget deficit or a trade deficit as an individual or a nation?
It's actually a very good point because, now I suppose I do overall, I run a trade surplus and that's good. But, 20, 30 years ago when I was a younger man, I actually ran a trade deficit. I was borrowing money every year just to fund my expeditions.
Like if you were going to college.
To Costco because I wasn't getting paid enough.
Because you're investing in your future as a young person.
But that's okay because I knew that over time I'd get paid more. And that's actually true for example, emerging market economies. It's okay for them to borrow a whole pile of money to grow their economies because they're young. They've got plenty of room to grow. We are an old, mature economy. Our economic growth is going to be about 2% in the long run. In this kind of economy, and with so many people retiring, we actually should be running a budget surplus.
We should be running a budget surplus, which means that we wouldn't have to borrow as much.
And a trade surplus. We should be storing up money to pay for our retirement. And of course, we're doing exactly the opposite.
Thank you, Mr. Kelly from JP Morgan, for explaining why rates are going to go up. Not as many people are going to buy our debt, and we're borrowing huge amounts of money. On the short term, all we're looking at is basically one CPI report to show that rates are doing better. Here's a live shot of the 10-year. It's at 4.43, which used to be resistance. I wonder if it supplies as support now. So, I am not on the bandwagon. Maybe you are. I'd love to hear your, pick for rates for next year. I think rates are going to go higher. That's just me. I could be wrong. What do I know? I don't know. All right, moving on. Pandemic housing boom, as explained by the Richmond Fed president. Lance Lambert is entirely wrong here, by the way. He is saying that work from home plus peak millennial buying plus institutional bull rush, I don't even know what that means, second home buying wave, constrained supply, high construction costs, skilled worker shortage, aging in place. Those darn people, they keep on living in their homes that they bought. How dare they? Right? We saw that bad take from the Globe the other day. So here in this take that is getting a lot of publicity, the Richmond Fed president is basically saying that all of these things are why we're in the housing pickle that we are now, and that the only way out of the current housing pickle is to build more housing. You have heard that from Neil Kashkari, also from the Fed, Minneapolis, I think. He said that about a week and a half ago, which we lambasted on this channel. The problem is that when you bury down into this story, into his quote, he doesn't take responsibility for what is actually driving all of this economic activity. But fortunately, he actually admitted it, but he doesn't connect the dots because he says, with interest rates low, people started looking for new places to live. With fewer people per household, millennials began to settle down. Institutional investors added to demand, as did second home purchasers. Say that again. Why did they do that? What is the responsibility for all of that? Oh, low interest rates. Artificially low interest rates. Artificially low interest rates, which we had for like 15 years. 9 years, we had basically 0% interest rates, and then they bumped it up to like 2% or whatever it was, 2 or 3%. But all of these years and years of low interest rate basically prompted all of this economic activity, a lot of which was malinvestment, bad choices. Bad choices. We're going to talk about some bad choices out of Los Angeles in a minute. All of these were bad choices. All of these spurred economic activity, which was not merited by the cost-benefit analysis, except for the fact that the money to do it was effectively free. Whose fault is that? Oh, the Fed. Oh, where does this guy work? Where does Mr. Barkin work? Oh, the Fed. He's been there since 2018. So, you say it's all of these people that made all of these decisions, but you're the one that provided the conditions for those people to make the decisions. You're the Fed. You're the one that kept the interest rates so low. Take some responsibility. Home builder sentiment drops to the lowest point in a year, but falling interest rates spur some optimism. By the way, this morning, and let's see if we can get this number here. This morning, we have housing starts coming in this morning. Let's see what they came in. We're expecting 1.35. Do we have an actual number at the moment? We do not have an actual number at the moment. We'll look for that in a minute. Housing starts were expected this morning. We had some good news from the theft department. So the theft of real estate, by which I mean rent control, has hit a little bit of a rocky road here in Massachusetts. The thieves were very excited that they'd be passing rent control in 2024. We, in our infinite wisdom here in Massachusetts, outlawed rent control in 1994 by a ballot measure. Statewide ballot measure outlawed rent control, but the thieves are back, and they were going to put it on the ballot for next year, but they didn't get enough signatures, and they were not going to get enough signatures, so they pulled it off the ballot, and instead they're going to the legislature to try to get it approved. That does not look promising, so it does look like rent control will be dead at least this year in Massachusetts, which is great. The thieves have been at least stymied at this point, which brings us to Los Angeles, 3,000 miles away. The LA City Council, in its, again, infinite wisdom, has now voted to end a 3-year freeze on rent hikes. Can you imagine owning a rental property in Los Angeles? I can't even imagine that. They are now going to allow you to raise your rent. Here it is here. Sorry about that. Scroll down too far. Between 4 and 6%. You can raise your rent 4% if you don't pay for the utilities, or how is it going? Here we go. Landlords who cover the cost of utilities can raise it 6%, and those who don't pay utilities can raise it 4%. Yeah. So, wow. Imagine being a landlord. Thank you, boss. Thank you for allowing me to operate in the so-called free market. By the way, the reason why they came up with these percentages, 4 and 6%, is because they based it upon inflation over the last year, which was, how do I want to say this? Deceptive, because it wipes out the huge inflation run when inflation was 9% in 2022. So, right. So those landlords that had rental property then, and which are probably pretty much the same group of people, they are now getting a 4% base raise, but they still had to pay everything that was extra from the 9% inflation from 2022. And remember, inflation's cumulative, so 4% gets you basically nowhere. You are still way far behind. you're effectively you're basically a thought criminal if you provide a rental unit in almost anywhere in the United States, right? Especially in any type of urban area. How dare you provide a housing unit? You're just by providing housing unit, your housing is a right, and it should be provided for free. Okay. Also from Los Angeles, everybody's in panic mode. Rich LA homeowners rent mansions for $150,000 a month. My God. So this article from Zero Hedge features this guy. He owns 5 super luxury properties in LA, and he can't sell them, and he's trying to rent them out for a couple of $100,000 a month. This is the perfect example of a malinvestment that was spurred by, fill in the blank class, excessively low interest rates. This is the type of bad investment that is spurred by the Fed. Here he is. He's trying to rent his 13,000 square Manhattan Beach estate for $150,000 a month. This is a hedge. I believe leasing it out will highlight the value of the property in a much better way rather than just shutting off the lights. Yeah. Okay. A lot of homeowners took on homes and mortgages and extra vacations homes when lending criteria was easier. I feel like everybody's in panic mode now. By the way, LA has just passed a new transfer tax on selling properties above $5 million. How dare you sell a property above $5 million? We're going to tax you more. We're going to take more of your money. We're going to steal more of your money because heaven forbid you make a profit in real estate. Back to Mr. Barkin, because I'm not done criticizing what he had to say about why everyone, built up these bad investments and now are paying for them. But he also says that the only way out of this, that the Fed cannot solve the problem. Basically, he admits the Fed can't solve the problem. I'm sorry, I should have brought this up earlier in today's lesson. But he said that the only way, again, echoing Neil Kashkari's comment from a week or so ago, the only way to get out of this current problem is to build more supply. But of course, that takes forever. One more situation here that was almost laughable. Out of the NAR conference in Anaheim, there's this article by Andrea B., which is just hilarious. NAR won't use his lobbying chops for a legislative fix to commission lawsuits. And then there's this guy, the Realty Alliance CEO, Craig Cheatham. Is he from the real estate firm of Dewey, Cheatham and Howe? He might be from the real estate firm Dewey, Cheatham and Howe. He wants to use NAR's connections with Congress to get us out of the jam. Here's his picture here. That's his plan. His plan is to go to Congress and get some type of antitrust exemption to get us out of the jam. That's his plan. Not that I'm in the jam because I'm not getting sued, but to get NAR out of the jam. He pointed out that NAR's Political Action Committee is on track to meet its goals and is flush with money. We went on the mat for the banks. We were ready to go to the mat for mortgage rate deduction and the 2008 downturn tax credit. We've got this handy lever. I think brokers just want to know, can we pull this lever in this situation? This is an existential threat to our organization. Is it not time to try? No, Craig, it's not time to try. Crying to Congress because you lost a court case, that's kind of the attitude that got you into this to begin with. To lobby your way out of this is not the approach. And all credit to the NAR legal counsel for basically shouting him down here for saying, no, we're not going to do that. Now, NAR has now recently beefed up its legal team with a former U.S. Solicitor General, I believe, and we'll see where that goes. They are going to appeal. They're promising that they have every confidence that they're going to win. Remember, it's not about the rule anymore. It's about the money. They already compromised on the rule, and they're going to compromise more because eventually the Department of Justice and or the judge in the case coordinating with the plaintiffs most likely will ban sellers from paying any type of buyer side commission. That's where this obviously is going today. All right. Hey, thanks so much for joining us. I'm Jack Gately from Jack Gately Real Estate. I have some commission checks to write. Very excited about that. Go make some money. Have a great weekend. We'll see you on Monday. Bye-bye.